Hi, this is Alessio. Hope you're well. In this video, I want to talk to you a little bit about what's been happening in the price of oil. So what's been fascinating everyone, especially in the mainstream media, is the fact that price of oil dropped a few days ago below zero. Okay, for the first time in history in the price of oil, we've seen the near-term futures contract in the price of oil drop below zero, as you can see here, go to the negative. But here's what actually I want to show you in this video, what everyone has been ignoring. So while everyone has been focusing on this, the fact that the May futures contract went below zero, I want to show you what everyone actually has not been looking at. Firstly, here's what everyone has been missing. So it is true that the May futures dropped below zero, but actually the price of the June contract, so the June futures contract for the price of oil did not fall below zero. Okay, so as you can see here, this is the June contract, and notice that at no time did the June contract fall below the zero level. As a matter of fact, it managed to recover and get back above the $10 level there. So did, by the way, the same thing also happened with the May futures contract. So even though the May futures contract dropped for oil, went below zero, which is that line, that's the zero line right there, notice that just the day after it recovered, went back above the zero line, as you can see there. So a quick recovery there. And that is not all. The price of West Texas oil at no point went below zero. I can see here today, just about the $13 level here. But also, here's what's really interesting. Here's what's absolutely fascinating, and I haven't seen anybody talk about this in the mainstream media or in the financial media. So what is absolutely interesting and fascinating about this is the fact that XLE, which is the oil stock ETF, XLE, in case you're not aware, is the ETF or the index fund for the top oil companies in the world. For example, if you go to etf.com/XLE, and if you scroll down the page, you'll see this. You'll see the list of the top 10 oil stock companies in the world. And you can see, by the way, guys, that the top oil companies in the world, like Chevron, Exxon, ConocoPhillips, some famous names here, Schlumberger, and so on and so on. So these are the top 10 oil stocks in the world. And you will see, as I'll show you in a few minutes, these companies did not actually crash. By the way, here's another reason why someone might want to, for example, get into oil stocks. Because some people might ask, well, why would anyone want to buy oil stocks? Here's the reason. This is the dividend yield. Here's a dividend yield for XLE. Take a look at this. 12.4% per annum. That means you get paid a 12% income per year just for owning oil stocks. All right, guys? I don't know how many banks you know in America or Europe that pay you 12% interest on your money per year. So again, this is the companies within XLE, and this is the chart of XLE here. You would have thought, in fact, most people would have assumed that if oil prices crash, then XLE, in other words, oil stocks, should have also crashed. They did not. Notice, in fact, that at no point did XLE crash here. In fact, notice for the last few days, we've had nothing but green bars. So again, common sense, well, so-called common sense or fundamentals would have said if oil is dropping, then oil stocks should have also crashed by yesterday or this week, but they have not. And it's not just oil stocks, by the way, guys. It's also XOP. Let me show you this. XOP is the ETF for oil and gas exploration companies. These are the oil and gas exploration companies. XOP did not crash either. In fact, they've been going up, as you can see, green bars for the last few days. So this actually shows to me, and anyone can just see this objectively, that while oil prices are crashing, these other companies, like again exploration companies, energy companies, again the top quality energy companies, they are not crashing. They're actually holding above the 21 daily moving average here. In fact, here's XOP. XOP is holding above its 21 daily moving average here, and is about to almost test the prior highs, the prior April highs here. And the same goes, by the way, almost with XLE. XLE is holding pretty strong as well. So, by the way, just to show you, here's some examples of some of the top oil companies like Exxon. Here's ExxonMobil. Again, just going sideways here, did not crash. Same goes with CVX. CVX is the symbol for Chevron. There it is. Chevron actually just held the 21 daily moving average here. So the fact that you see oil stocks holding strong, holding their own, they're not crashing here, as you can see here. They haven't dropped back down, for example. They haven't crashed all the way down below the lows of March. As a matter of fact, they've been holding pretty steady here. So what this is telling you, and what this should be telling us, there is strength here. All right. The XLE, in other words, oil stocks are outperforming the price of oil. So that's a sign of strength here. And I would say this, and there are some people actually asking, for example, when would be a good time to get into oil stocks, for example? Well, That depends on how much risk you want to take on. So a trader who wants to, for example, get into oil stocks, what he probably would do, again, to play it more safely. Well, firstly, take a look at this. You'll see a gap here. On this chart, notice there's a gap right here. All right. So it's a massive gap that has not yet been filled. All right. There's a lot of gaps here, as a matter of fact, but this is the big one. So on the balance of probabilities, this tells us that it's quite likely that oil stocks may go back and fill that gap. What a trader might do to increase the odds, to increase the probabilities, would be to wait until oil, or oil stocks, I should say, oil stocks or XLE, gets above the highs of April. The highs of April were about the 36 level mark. I would say a better strategy would be to wait for the price not just to get above the 36 level mark, but to get above this yellow line, the 50 simple moving average here. The 50 simple moving average, by the way, is slowly catching up with price. So if we just imagine that this line, this yellow line, is slowly going to catch up with the price here, I would wait for the price to get above that yellow line, above the 36 level and above the 50 simple moving average here. Because once price gets above that level, that increases the odds of an uptrend developing. And using a stop loss would need to go below the lows here, below the lows of April, just about the 29 level. And by doing this, essentially what we're doing is limiting the risk. That means the risk we're taking here is this much. Okay, so small risk, but potentially bigger return. So personally, at the moment, I would just wait for the price to get above April highs and the 50 simple moving average to increase the probabilities and to reduce the risk on that side as well. By the way, before I finish, I know there are some people thinking right now, why would anyone want to buy oil stocks when the economy is looking like it's going to go into recession and everything like that? Okay, so let me just make sure I explain this point, because several people are not going to get this. Firstly, as a contrarian, you have to go against what the herd, what the majority thinks. Secondly, the great investors out there, the great investors like Warren Buffett, Peter Lynch, they don't care about things like the economy or fundamental analysis. They look at good quality companies which are extremely undervalued. Okay, so for example, let me just show you this. Let's go on a monthly chart, and I want to show you this. So just take a look over here. All right, this is the year 2009. All right, guys, you see, this is what happened in the year 2008. 2008, you see a massive crash in the price of oil and price of oil stocks. Look where it bottomed here. They bottomed in 2009. Similar with the stock market, by the way. So notice from 2009, they started rallying higher. So we saw a rally in the price of oil stocks in 2009. The rally continued all the way to 2011 as well, and further higher, by the way. Consider this point. 2009 happened to be the worst part of the economy. You had the highest amount of unemployment, bankruptcies, and all economic bad news in 2009, and yet that is the year oil stocks actually managed to rally higher. So just remember, guys, you cannot expect stocks or stock prices to follow what the economy is doing. The stock market is not the same thing as the economy. I've mentioned this several times before, but people just forget this point. Do not make the same mistake that everybody else makes, which is to think that the stock market is the same thing as the economy, or that the stock market has to do the same thing as the economy. The best investors in the world are contrarians, and they look at the price action. That's the only thing that matters. All right, guys, thanks very much indeed. I'll see you guys in the next video update. Bye for now.